We have an exciting panel led by Mr. Matthew Winkler, who founded Bloomberg together with Michael Bloomberg in the 1990s. And during his 25 years as editor, this news organization has won every single possible prize, including the Pulitzer Prize. So he is clearly the person to tell us about the exciting challenges that we are facing. And I'd like to invite Matthew Winkler, Editor-in-Chief Emeritus of Bloomberg, to the stage. Please.
Thank you. Thank you. Thank you very much. It's a great honor to be with all of you, and following on the heels of that wonderful, all too brief discussion is an especial privilege. Being from Bloomberg, I can't talk about anything without sharing lots of data. That's what we do. And I thought in the context of innovation and growth, one way to look at the world right now, the way we look at the world, is what's going on in capitalism. And if we take 500 companies, the largest 500 companies in the world by market capitalization, and you can see them on the screens here, and if we group them into four categories, the most, the second, third, and the least, market capitalization growth, we see some very interesting trends. The fastest growing group added 192% in value. That's the first group. But it also has, being the fastest growing group, the highest amount of research and development committed in total revenue, which is 8.9%. The last group, which lost 16% in value. This is over, by the way, a period of 3 years. The last group spent the smallest amount on R&D to total sales, 6.3%. So that's a snapshot of the world as we know it, globally competing. When we look at Israeli companies, which spend 11% of their revenues in R&D, they actually rank very high among their peers. If you look at very closely at this data, Israel is above Switzerland, Denmark, Finland, even the United States, Germany, in the amount of money that's committed to R&D. And if we look at the share performance of these Israeli companies, these are technology-focused companies, there are 56 of them listed on the TASE Blue Star Israel Global Technology Index. And the stocks from these companies underperformed the MSCI World and the S&P Information Technology Index during the past 10 years, 5 years, and even 1 year. And during the past 10 years, these Israeli firms returned 57% to their stockholders, which is about 82 percentage points less than their global peers and 128 percentage points less than the US tech companies. However, if we look at this year, we see that Israeli tech companies are outperforming every other benchmark so far this year. The shares have produced a return of 17.5% total return, and that's 1 percentage point more than global peers. And so a question I think we will try to address momentarily is this a trend here to stay? One example, by the way, is Mazor Robotics, produces surgical robotic systems, and it's beaten its analyst sales forecast for 5 consecutive quarters. Its shares have gained 61% in the past 3 months. Another example is Wix.com Limited, and that helped customers design websites, and it returned 82%. That's a total return to shareholders this year after beating sales forecasts 7 quarters in a row. The 56 companies that I mentioned take up 12% of the Israeli stock index, the TA 125, in terms of market capitalization. And it's 8%. It was 8% a year ago, so this percentage is growing. European tech companies, by contrast, are about 4% of European stocks. That's the Stock 600 index. We were just talking about the challenge of our time in the 21st century, which brings us to one of the most important industries that is growing at a relentless rate, and that is clean energy. And when we look at clean energy versus energy around the world, there are 130 major companies in the Americas, North and South America, with at least 10% of their revenue or their firm value in what is known as clean energy. And that's data that we have compiled at Bloomberg through our colleagues at New Energy Finance. During the past 10 years, ending a year ago, traditional energy companies outperformed these clean energy investments by 48 percentage points. However, since a year ago, the clean energy companies have gained 27% when the traditional energy shares barely managed 2% total return. And this year, clean energy companies have gained 13% against traditional energy companies losing 9%. So we think, based on this data, that this dichotomy that you're seeing is not temporary. It's likely to persist. There are a number of reasons why it might persist, and again, that's a discussion point for us momentarily. But let's take a look at California. You know, for those who are not quite familiar with California, it obviously is the largest state. It accounts for 1/8 of the U.S. population, and it's 1/7 of the U.S. economy. So there are 50 states, so California is 1/7 of that. In clean energy, California has 20 of these 130 clean energy companies. They're domiciled in California. These 20 companies gained 45% during the past 12 months, when the benchmark was 13%. Their annual revenue is 27%, almost 3 times the benchmark's measure. Not only did their sales grow faster, they can turn more revenue into profit. Their gross margin is 46%. That's against 41% for the benchmark. They spent 13% of revenue on R&D against 8% for the benchmark, and they added 14% in terms of staff, new employees last year, and the benchmark was 6%. So just about on every front, profitability, employee growth, sales growth, every measure an investor might look at, California and California clean energy companies in particular not only lead the U.S. And South America as well, but they probably are leading the world in this. And it's not an accident. Part of it is a convergence of policy and also of people's preferences. When we look at Israel, back to Israel, and say, as a developed economy, it's comparable, at least in population, to Sweden, Austria, Switzerland, Denmark, Finland, and Singapore. Among these 7 countries, Israel's economy is likely to experience the fastest growth. Its GDP, according to analysts that we survey at Bloomberg, its GDP will grow 3.3% in 2017, and again 3.2% in 2018. And that is, by the way, greater than these countries. And also something else, and it's a bit of a wild card for reasons I'll elaborate on momentarily, is that among these similarly populated countries, Israel, as everybody in this room knows, has the highest percentage of people under 15 at 26%. Now, every problem is an opportunity, and as central bankers like Stan Fisher and his successor have discussed this subject in Israel, the Haredi population is growing faster, 4% annually, and You can expect an average Haredi woman to have 6.9 children, which is extraordinary. But just to quote a Jerusalem Post editorial from last year, late last year, the Haredi community of the future will be very different from the one we know today. Instead of being a drag on the economy, Haredim might even become a catalyst. So we'll see. But that's an interesting statistic and one that bears watching, at least in the context of growth. The shekel, its implied volatility has increased 5% this year. When we look at the Singapore dollar, the Swiss franc, the Danish krona, the Swedish krona, they've all declined more than 20% in implied volatility. And this is kind of a measure of, uncertainty. So what's going on here? Doubtless, there are some people who have opinions about this, and maybe we'll get to one or two of them before we're done this morning. When we look at startups, and we have a startups barometer measuring both the occurrence and level of venture activities for US-based startups, excluding biotechnology. And the startup activities have dropped 44% since the peak in June 2015. And they're still, when you look at this chart, they're still 640% greater than the low in November 2009. But we're not seeing as robust in startups as we once did. And then when we look at M&A, mergers and acquisitions, foreign buyers are paying right now a 57% premium. That's the highest premium, at least during the past 12 years, for assets in Israel. They have spent at least $3 billion so far, and before you wonder about what that figure means, I'm going to elaborate in a second. But if this trend continues, the total transaction of the year will be about $9 billion, which would make 2017 the second busiest year during the past 12 years. Now, there is a company we call an Israeli company called Mobileye. It recently was acquired by Intel. It was a very big acquisition. But when we look at that data at Bloomberg, most of the sales, and going all the way back 13, 14, 15, and 16, most of the sales revenue for this company is in the United States. It's a listed company. In some ways, it's a good example of what we're talking about here, I think, in this conference, because it's a global company. It's a company started in Israel, as you know, and highly important in the auto industry now. And it is very much indicative of the kinds of companies that come out of Israel and that very rapidly become global superstars. And we'll talk about that, I'm sure, momentarily. The most acquired industry right now in this context is consumer non-cyclical. And between 2012 and 2016, the most bought industry, that is the most acquired industry, was technology. I want to share with you, finally, just a slide. I mentioned California before because it's interesting in the context of innovation. What's the difference between these two states, California and Texas? Texas being the #2 state in the United States in population, also in economy, generally speaking. But California is overwhelmingly #1. It's not even close. Why is California so dominant? And I mentioned before, by the way, that California is 1/7 of the GDP of the United States. Maybe something that people didn't think about too much in the context of last year's election, but it's a very important, qualifier. What is California? If you look at corporate California today, you will see incredible diversity. But the most important part of that diversity is that almost 40% of corporate California is technology, what comes between your ears. Almost 40% of that. If you looked at the largest companies in the world today, 9 of them are based in the US, 3 of them are based in California. You know them almost instantly. There's a company called Apple, there's a company called Alphabet, and there's a company called Facebook. They're all examples of what I'm talking about. But that's not all California. California's communications, that's 22%. California is financial, that's 16%. Healthcare, 9.4%. And then energy, consumer, discretionary, utilities, consumer staples, industrials, and materials make up the rest. Texas, by contrast, almost 57% is in the ground. It's, you know, the last century or the century before. 58% almost of Texas is energy. 11% is communications, and then a smattering before. So in the context of innovation, clearly what gets investors excited more than anything else is technology. And of course, technology is what's driving innovation today. Steve Ballmer recently, former CEO of Microsoft, was asked a question in this town a few weeks back at the Economic Club of New York. If he had to do it all over again, you know, what would he do? And he said, I'd do exactly the same thing. It's software. It was software then, it's software now. And that's software that's driving business. So thank you very much for letting me share this data with you. And I think we're on to the next.